Hello there, Maverick Traders. This is Rob. It is another weekend. Let's jump into the trading room. In this session, we're going to talk about what happened last week. We're going to go through the broad markets. Then we're going to take a fresh look at the markets. We did have some changes this week, no question about it. We're going to look through all of the sectors, score them from +3 to -3. And then I've got 2 bulls, 2 bears, and a sideways for you.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
The first 3 days of this week were weak. So we started negative, we got meta earnings that pushed the market down, and the markets bottomed out a little bit after that. And then on Wednesday, we got the FOMC, and it was a really wild day on Wednesday. I mean, look at this chart, this intraday chart. We shot up like from negative down about 0.3% to up 1.3%. By the end of the day, we were down 0.3%. Let's talk about what the Fed said. First off, they did not change or cut interest rates, which was as expected. Number 2, what also was expected was they were going to do a hawkish pivot. Remember them saying they were going to probably cut 3 times this year? But they have completely wound that down to say they're now a little bit more hawkish, and they don't think inflation is going to come down this year. What the market did like is they announced that they're winding down their quantitative tightening. What this means is that just think of all the bonds that they have sold over the years after COVID. What quantitative tightening means is that in COVID, they sold a lot of new bonds and they created a lot of new money. And what they were doing was when they were getting new money in, they were issuing more bonds. Quantitative tightening said, hey, we're not going to do that anymore. We're going to not issue more bonds. So when a bond that they sold came due, they didn't renew it, which meant that the money supply shrunk. They've been doing that now for about 2.5, 3 years, and they've announced that they are going to be winding that down. So they are actively moving away from shrinking the money supply to more keeping it neutral. That is good for the market, and ultimately the market did cheer about that. And then on Thursday, we got Apple and Amazon beat earnings, gave the market a boost, and the market was in a good mood for the rest of the week. If we take a look at all the news this week, a couple things just really stand out. 1 year ago, the Fed said, hey, we want to see jobs coming down. So we got 2 reports this week of jobs that are starting to soften. So these are the numbers that said, okay, the jobs market is softening a little bit, and that's really good for inflationary pressures. Here's the problem. When you look at inflationary pressures, take a look at employment cost index. And then we got things like the ISM index, which was weaker than expected, but one of the components on it was stronger on payrolls. Prices, manufacturing prices were up. So what we're getting here, and the Fed does not want to admit that we might be heading towards stagflation, which is low growth and high inflation. That's a really bad thing to happen. And that's really where the market is right now. So the big question is the market's looking at all these numbers. Corporate profits were really good this last quarter. They're looking forward saying, we don't see a recession. We no longer see rate cuts. Where do we go from here? Guess what? It's looking like a 2% growth economy, which is what we had the entire 2010s. And the stock market did just fine in the 2010s. So I think the investors out there in the market is looking at this saying, okay, we were looking at worst case scenario, and now it's just not worst case scenario. It's not great, but we're definitely now more in the neutral camp. For the weekly returns, we can see the Dow up 1.17%, Qs up 1%, Russell up 1.78%, S&P up about 0.5%. We need to take a look at the charts because, again, it was a wild week. We had big moves on both sides. Take a look at that move in oil. Oil got absolutely crushed. The energy sector that was holding on, it is no longer holding on. We'll take a look at that as well. Let's take a look at this S&P chart. So over the last couple weeks, we had this breakdown where we went from positive to negative. We had this rally and we fell. Then we had this green candle. We had two more extensions and then we failed absolutely miserably at that 50-day moving average. Big down move. This was the Fed day. Right here, this is the Fed day. And then we got earnings, gave the market a boost, and earnings. So as you can see here, we're pretty much where we started the week off. We're a little bit higher than where we started the week off, but a lot of intra-week volatility. We are still, again, I'm not going to say below the 50, we're at the 50-day moving average. So we can't say that we're bullish because that is our line in the sand. Now on Monday, could we say we're now going to a +1 lean? Sure, absolutely. But right here, right now, where we are, this is still a 0 on the market. So I think the best you can hope for here is a 0. Taking a look at the NASDAQ, same thing here. We're between the two moving averages. The moving averages are flattening out. This is a 0 as well. I also want to take a look at the bond market. The bond market has cooled off up here. The market did not like it when it was up here. Now that we're down a little bit less, the market really liked it when we were down here. You can see we're right in the middle of that range. I really am looking at this market thinking this is a pretty neutral overall marketplace. Whenever I look at markets and I really want to just say, okay, let me start with a clean slate and let me take a look at where we are. Can I come up with a reason, come with a scenario where we're going to have a new bull market run and everything's great? And the answer is I can't. I can't write that essay for you. Now the question is, can I write an essay for, hey, things are going to get really bad and we're going to go into a bear market? Remember, all during this bearish move, I've been saying, do not expect this to be a long bearish move. It's likely to be short and sharp. Now, one point is going to retrace. Here we are. We're back at the 50-day moving average. It's no longer bearish. We're no longer on our heels. So when you take a look at this, the two possibilities is we're either going to go into a new bull market, which I can't see. We're going to break down into a lower low, which I just can't see. The most likely scenario is some sideways action. Some sideways action with maybe a little bit of a bullish lean to it. Because again, we did have that not big panic, but we had that push down and the market held. It might attract some new money into the market. So I'm going into really the next couple of weeks here with a very, very neutral lean. I am not looking for this market to go up or down significantly. And like I said, if anything, I'm going to do like a bullish bias, maybe a plus 0.5. But I need to see us get over that 50-day moving average. Look, for me to go to 0 to plus 0.5. That's really all I'm looking for here. On the schedule next week, there's absolutely nothing. So I think you just have to take a look at where we are. We're off our highs. We're off our lows. We're in the middle of the range. Do we see an impetus for some big move up or down? No. We're through earnings. Earnings are no longer going to push us anywhere. Again, we're off the highs, off the lows. I am really solidly neutral here. And like I said, if anything, I'll give a +1 lean because we are higher than we were here. We are higher, and give me one more candle, and then I'd say, okay, I'm confident in my plus 0.5. I know, very, very crazy leaning here. I think we have to look at this market as we're probably going to be stuck in the range for a while. Guess what? That doesn't mean that every sector is stuck in a range. So let's go down and break down the sectors, and we're going to find where we should be bullish and where we should be bearish and where to be neutral. All right, taking a look at the performance last week. You can see that most everything was in the middle except for the outliers. Utilities had a huge run and energy had a huge fall. What was strong? Tech, consumer. We're going to take a look at real estate. It had a bounce, but real estate had been absolutely crushed. So really the standouts were consumer and tech outside of utilities. Utilities did awesome. we've had a couple trades in utilities that look great here. Financials. Financials were the one down sector outside of energy. We're going to take a look at that. I've got trades working in financial. They're actually working really well to the long side. I don't love that the sector isn't keeping up and pushing higher. Let's jump into the individual charts. Here is the utility sector, clear +3. I mean, there is no question about this. Above the 20, above the 50, both of them sloping higher. It's a +3. Doesn't get more clear than that. Here we have the communication services. Now we're going to see this pattern on a few of these sectors here. I want you to really look at the candles, okay? I want you to take a look at the candles that happen to get back up to the moving averages. All right, so here we have these candles that opened up, had a little selling, but ended up closing above the open. This thing is still a little bit below the moving averages, so technically I got to give it a -1. That's where it is. But this one tells me it's probably got a little bit of momentum, maybe a little bit more. Now look, I just wanted to bring that up because I want to send you to the next chart of real estate. So look at real estate. We didn't get all that great of candles. This is an okay candle, but this is not a great candle. Remember the candle we just saw on comm services on Friday, and this is just not the same candle. This is closing on the low. So real estate gets a little bit of an upgrade, but it's only an upgrade to a -2. We come over here to the healthcare sector. Look at these candles. These candles are not good whatsoever. Did it go above the 20? Yes, so we got to bump it up from -3 to -2. But look at the candles. The candles are not telling you that there's a ton of money flooding into these. And we come over here to the industrials. You can see that we had, again, a decent candle on Thursday. You know, it's not terrible. It's not like healthcare looked, but it's not as good as communication services. This one is trading a little bit above, so I got to give it a +1. Look, if you want to give these all zeros, you want to give comm services a 0, this one a 0, absolutely. It's not really that big of a difference. Coming over here to financials. Financials. I'm going to give this a -2. If you want to give it a -1, that's fine. If you want to give it a 0, that's fine. But what I'm really looking at, look at these candles. Thursday and Friday were big up days, gap ups and runs. These were gap ups and fall, gap up and fall. So for me, financials is showing a little bit more weakness. Look, they're all right there as zeros, but we're really trying to find out, okay, what's a weak 0? What's a strong 0? I know it's kind of a dumb thing to even be talking about. Maybe we need to break them into some decimals to where we're like, 0.7. Okay, we're not going to do that. We're going to stick with what we're doing. Here is consumer. Good candle on Thursday. Big gap up, but not a great candle on Friday. So we're just going to give this one a 0. Doesn't look like it has a ton of follow through. Come over here to tech. Better candle. A better candle over here in tech. We are still below the 20, above the 50, and the lines are straightening out. It's a 0. But again, look at the difference between the candle on Friday in consumer and the candle on tech on Friday. It's just telling you there's a little bit more buying going into this sector. Let's finish it off with materials and energy. Not great. Not great. We are actually below moving averages, so we got to go to a -1. Again, this is not telling me to go long or short. This is telling me this sector is a pretty neutral here at the moment. And then we take a look at energy. Really big selling here on Tuesday and Wednesday. No bounces. And the best thing we can get is the market saved it on Friday with this little bounce back at the end of the day. But this was looking to be a really ugly day on Friday. We're going to go to a -2 on energy. So let's take a look at the movements here. The things that got upgraded: utilities, industrials, consumer, technology. Those are the ones, again, we're seeing some strength move into. Yes, healthcare went from -3 to -2, but Look, it's not great. It's still a -2. What weakened here? Well, we got some weakening in energy, which we noted, weakening in materials that we noted, and those financials have weakened a little bit. This is leaving us with some pretty clear shorts. Energy, healthcare, real estate, right now looks like to be the weakest sectors. Utilities looks great. The problem is there's not a lot of utility stocks. I already have 2 trades on utility stocks. I don't have room for another one. So I'm looking for industrials, tech, and consumer for my bulls here. Lo, let's go ahead and take a look at some of those possible trades in some of those sectors.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
All right, comm services. Now, comm services, I'm a -1. I'm looking to be mildly bearish. So I was out there looking, trying to find, okay, what is going to stay weak? I don't need something to fall apart. I just need something to stay weak. And I come across as DoorDash. We had earnings, gap down. We did have that big recovery on Thursday. Now that's fine. That's a pretty nice little candle there. But take a look at what happened on Friday. We gapped up on Friday. Friday was a really strong day, and this thing sold off all day long. That's telling me that there is not buyers coming into it. Just think of the money that came into the market on Thursday, Friday. It was not coming into DoorDash. I'm liking this one. Look, I'm not saying this thing is going to crash. I think this market isn't going anywhere. So I don't think anything's going to have a very big move. So I'm going to be taking a look at just some mildly bearish trades. This is the one I'm going to be looking at most likely, is the 113, 116 bear put spread. One of the things we are going to be doing here over the next couple weeks is we're going to be incorporating some of the trading collective ideas that we've been using into the trading room. This is going to be one of them. When I give a possible trade setup, I'm going to give it a ranking like a -1. This is mildly bearish. This is a mildly bearish trade. This trade down here is a moderately bearish trade. It's a -2. So basically saying, okay, you get to look at these possible trades and say, okay, how bearish do I want to be with this allocation of capital? With this allocation of capital, I want to be more bearish, and I want to be more bearish in this sector. You may choose the May 17th, 111, 114 bear put spread. Someone says, hey, I want to be less bearish. They're going to be taking a look at some other possible trades. This is one of the things we're going to be adding in to the trading room going forward, is basically just, you could go and look at these and pull up the options chains and look and see, okay, this is where everything is. I'm going to go ahead and just do it for you. Be like, hey, this is mildly bullish, moderately bullish, mildly bearish, stuff like that. So for me, I'm looking to fill a -1 slot. I'm going to be taking a look at this May 17th, 117, 116 bear put spread. All right, moving on to the next sector that was also weak, healthcare. Here is Exact Sciences. I love weak stocks when they have bear rallies. I love these little bear rallies. Great little opportunities to take a short position. We've got a nice bearish candle on Friday. Give me a red one on Monday. That's going to be a really nice bear rally pattern. So the question is, what are we looking for? Well, if you're looking to be mildly bullish or bearish, a 60, 65. It's going to be from here up to here. You're basically saying, I think it's going to be below 60. If it goes above 65, I'll take my max loss. Anything here below 63 is likely going to be a profit. So as you can see here, we don't need it to fall. It just has to not go up. If you want to be a little bit more bearish, then the 62.60.60. That's going to make it to where you need it to go down below 60. You need a bearish move on this one. So EXAS, Exact Sciences, in the healthcare sector. I didn't have a lot to choose from bullish because remember, we have utilities, it's at a +3. And if you already have too many utilities, now we got to go down and say, okay, what's the next strongest sector? It was industrials at +1. This stock absolutely refuses to go down. It does. We've got earnings out of the way. And this stock didn't even react this week to the market weakness at all. I mean, at all. You know, okay, maybe not a great candle on Friday, but that's fine. I mean, look, this thing looks like it just wants to continue grinding and grinding higher. The matter is, how do you want to play it? You want to play a +1. Here's a possibility. We got a 60 delta bull call spread, 162, 165. You want to get a little bit more aggressive, give yourself a little bit more time. The May 17th, 163, 166 bull call spread. And we're not asking these to go up a ton. Not a lot of, we're not 163, 167, I think it was. That's not a big move. We just needed to move above this 167. And that is a really nice gain on this. Remember, when the market's at a 0, I don't like to go out to +2s and +3s all that often. You know, I'll save my +2s and my -2s for the absolute best and worst sectors, but I won't do any -3s or +3s. Not in this kind of market. So I take 1 or 2 shots at +2, but everything else is a +1. Consumer was upgraded to a 0, which is, again, one of the better sectors. And this here is C Limited. Now, I do want to point out that they do have earnings May 14th. So a lot of my trades, I say like a +1. I want to go ahead and not hold during earnings. That enters in too much volatility. I might be looking at something like a May 10th, 65, 67. So that's just 1 week. But a 65, 67 basically saying, just don't go down. We need it to be above 67 by Friday. 65 is going to be the mass risk here. If it does not break out and run and it tanks, okay, well, we've got our risk in place. If you want to be a little bit more bullish here, I think you do have to go through the earnings report, but I think you can take a look at like a 65.70, saying, hey, I think this thing really is going to burst. That's going to be a +3 trade as far as Delta goes. But SEA, again, this one completely ignored the down days this week and completely celebrated the up days. That's what you want to see. Let's also go into tech. It moved up to a 0. Here is Texas Instruments. Texas Instruments had some earnings news. It gapped up. You can see right here, this 175 has been a nice floor for this. And here we are trading here at the top of the range. Will it break out and run this week? I have no idea. No idea. And guess what? I might not even play it that it needs to do that. I could take a look at this +1. There's a couple of ways to play a +1 here, where you're just saying, just stay up in this upper area. Just stay up in there. As long as you can stay up in here, maybe close it a little bit above that, I'm very happy. I think that's the way to go. You want to be a little bit more bullish? Okay, give yourself 1 more week. Go out to May 17th and take a look at the 178, 182, which is going to be up to here. That is not asking Texas Instruments, a $180 stock, to go up 3 points. That is not asking for a lot. That's like a 1.7% move in 2 weeks. Very, very reasonable. All right, now look, we're at a 0. Just understand, that's fine. We have a saying at Maverick, trade the market in front of you. Not the market you want it to be, not the market you think it should be, just the market that is. Here we are. We had a little bear move. The market shook it off. It looked a little dicey there for a second. Here we are back to the middle of the range. I think a lot of people are looking at this market just like me saying, who knows? Who knows? But what I do know is the volatility has come out of this market. Take a look at the VIX. Take a look at all the volatility measures. That's come out of the markets. And I think that is probably going to stay there. Now, again, I shouldn't say stay there because nothing ever stays there in markets. It's all cyclical. But I think that, again, the panic is gone. We see that in the falling volatility numbers. But we really don't see this runaway bullishness. We don't see it yet. I think, here's the question. Was there enough damage done for a new bull run? So, follow me here. People who have been putting money on the sidelines, waiting for a better opportunity to enter the market. Was that enough damage? Was that enough sell-off? Was that enough of a discount for those people to say, hey, that was enough of a pullback, that this money that I've been sitting on for 3 months, I'm going to put it to use now? I don't think it was. I really don't think it was. I think those people are still waiting for a deeper pullback. So where does that leave us? We aren't in the panic anymore. I don't think there was enough of a pullback to get that new money in, saying it's so cheap now, I got to get in. I'm telling you, I am looking at this as a zero kind of market. What we do is we do chicken bulls, chicken bears, find your sector that's really strong, really weak, and make a little bit of a directional trade there. But for the most part, we just kind of have to sit and wait for the market to develop something better. That is it. I wish I could tell you it's different, but guess what? That's not going to do you any good because, yes, we trade the market in front of us at Maverick. Everyone have a great weekend. Take care. Goodbye, everybody.